Hi everyone, welcome to my channel. I am Yuvaraj and in this video I will be explaining projects related to the company law and secretarial practices paper, which is an allied subject in the semester syllabus of second year BCom, fourth semester. My goal is to provide valuable insights and guidance to help you to successfully complete your projects with confidence. Stay tuned and let's dive in. Today we are going to see about joint stock company. Joint stock company is a business organization where capital is raised by issuing shares to the public or a limited group of people. Each share represents a portion of ownership in the company. The shareholders contribute capital and in return they receive share that represents their ownership. The company is a separate legal entity, meaning it can be own property, enter contracts, sue and be sued on its own name. Joint stock companies are typically formed to carry out businesses venture with the goal of generating profits for shareholders. It allows individuals to pool their resources for business purposes while minimizing personal risk since the liability of the shareholder is limited to the amount invested in shares. Definition of joint stock company. The definition will be varied according to the perspectives, and the perspectives are corporate perspective, legal perspective, economic perspective, business perspective and accountancy perspective. Firstly, we are going to see about corporate perspective. A joint stock company is a business entity wherein the ownership is divided into shares that are held by individual shareholders. Each shareholder is liable only to the extent of their shares in the company, making it a form of limited liability company. The shares of the company are transferable, which allows for fluidity in ownership and provides opportunities for raising capital through the sale of those shares. Second one is legal perspective. A joint stock company is a legal entity separate from its shareholders, where the capital is divided into shares of stock which can be bought, sold or transferred. The company itself enjoys legal rights and obligations, and it can sue or be sued in its own name. Shareholders' liability is limited to the unpaid amount of their shares, and their personal assets are not at risk. Third one is economic perspective. A joint stock company is a structure for pooling together financial resources from multiple investors, allowing individuals to combine their capital to fund large-scale business operations. The company is an efficient vehicle for raising large amount of capital by issuing shares to a broad group of investors, which help in undertaking expensive business ventures with the shared ownership. Business perspective. A joint stock company is a form of business organization where the ownership is represented by the share of stocks, which can be transferred and traded, giving rise to the decentralized form of ownership. This structure allows business to raise capital from a large number of individuals while offering a mechanism for sharing profits, risks and control over the company. Following the business perspective, we are going to know about accountancy perspective. Accountancy perspective. A joint stock company refers to an organization that issues stock of shares to raise capital, which is divided into fixed portions known as shares. Each shareholder's stake is proportional to the number of shares they own. The company has its own legal identity distinct from that of its shareholders, and the value of shares fluctuates based on the company's financial performance and the market's condition. And the definition topic is over, and followed by this kinds of joint stock company will be continued. End of joint stock company. In this section, the concept of joint stock company explains about the formation and the major categories based on structure and ownership will be explained. The first kind is based on liability. In liability type, there are two categories. They are limited liability company and unlimited liability company. In limited liability company, shareholders are liable only to the extent of their shares. And unlimited liability, shareholders have unlimited liability, meaning they are liable for company debts beyond the value of their shares. The number of members. This is the second kind in joint stock company. Private company, a company that restricts the transfer of its shares and limits the number of shareholders. Public company, a company that can issue shares to the public and has no restrictions on the transfer of shares. Third one will be type of shares. This company will be categorized according to the shares. Company limited by shares. Shareholders' liabilities are limited to the unpaid value of their shares. Company limited by guarantees. Members' liabilities are limited to the guarantee amount agreed by them. Next, hybrid company, combination of both above features. And there are certain other classification, and they are holding company and subsidiary company, which means a holding company controls one or more subsidiaries, and the other one is government company. Companies owned by or controlled by the government itself. Formation of a joint stock company is a legal process through which the company comes into existence. It involves several stages, starting from the idea stage to the registration. In this section, I will explain the concept of company formation and its importance of business law. Firstly, we are going to see about promotion. Role of promoters. Promoters are individuals or entities that take the initiative to form the company. The scout for resources. Design the business model and raise initial capital. And the second one is pre-incorporation contracts. Promoters may enter contracts on behalf of the company before it is legally formed. And the second one is registration. Memorandum of Association, shortly known as MOA. In Memorandum of Association, a legal document that outlines the company's structure and objectives. It includes the name, registered office address, capital structure, and scope of the company's activities. And followed by that, articles of associations. This defines the rules and regulations of the company's internal management. The next one is application for registration. Filing with the Register of Companies ROC, providing all necessary documents. The third one is certificate of incorporation. The company becomes a legal entity once the ROC issues a certification of incorporation. This certificate acts as a proof of the company's existence. The fourth one is commencement of business. After incorporation, the company must obtain a certificate of commencement before starting its business operations. The fifth one will be post-incorporation of activities. Share allotment, appointment of directors, and holding the first meeting are the initial task after the company is formed. After following this, incorporation of joint stock company will be started. Incorporation refers to the process by which company is legally created and recognized by the law. It is the formal registration of company, making it a distinct legal entity from its shareholders and directors. The process of incorporation allows a joint stock company to have its own legal identity. separate from its member, and to carry out business activities as a legal entity. Definitions of incorporation. Incorporation is the process of registering a company with the relevant authorities. Example like the register of the company in accordance with the previous of the Companies Act of the country. Once incorporated, the company becomes a legal entity that can own property, enter into contracts and sue or be sued in their own name. It makes the official birth of the company. Second one is procedure for incorporation. The steps involved in incorporating a joint stock company are typically as followed by me. A selection of company name. The promoters of the company must choose a unique name for their company. Their name should not conflict with the name of existing companies or violate the trademark laws. Preparation of memorandum and articles of association. Memorandum of association. This document contains the company's fundamental objectives, the scope of its activities, and the location of its registered office and the amount of authorized capital. It is the most important document in the incorporations act process. Article of association. This document contains the internal rules and regulations governing the country's operations. It outlines how the company will be managed, the powers of directors, the rights of shareholders, etc. etc. And third one, filing with the register of companies. The memorandum and the articles of association along with the required documents such as the declaration of compliances and the details of directors are to be submitted to the ROC for the approval. And the next one, payment of fee. The company must pay the necessary fee for the registration, which are usually based on the authorized capital of the company. And the last one is issuance certificate of incorporation. Once the register is satisfied with the application, the company is officially incorporated. The register issues a certificate of incorporation, which signifies the company has been legally established and can begin its operations. Third one will be legal implications of incorporation. Once a company is incorporated, it becomes a separate legal entity, distinct from its member. It acquires the right to own property in its name and enter into contracts. The company can sue and be sued in its own name itself. The liability of the shareholders is limited to the unpaid amount on their shares. It has perpetual successions, meaning the company contributes to the existence even if the members or shareholders change. Going to see about characteristics of joint stock company. First one is separate legal entity. A joint stock company is a separate legal entity from its shareholders. This means that the company has its own identity distinct from the individuals who own it. It can own property, sue and be sued in its own name. The shareholders are not personally liable for the company's debts and beyond their investments in shares. Second one is limited liability. One of the most attractive features of joint stock company is limited liability. Shareholders' liability is limited to the amount they invested in the company. If the company faces the financial crisis or losses or debts, shareholders only lose the value of the shares they'll hold, and their personal assets are protected. This encourages investment and reduces the risk of individuals in investing in companies. transferability of shares. The shares of Jansta company can be easily bought and sold. The transferability of shares provides liquidity to shareholders, allowing them to sell their share in the stock market or to other investors without affecting the company's continuity. It makes the company's ownership more flexible and accessible to the public. And the fourth one is perpetual succession. A joint stock company has perpetual succession, meaning that the company continues to exist even if the shareholder or director change. Death, insolvency or bankruptcy of any shareholders does not affect the company's existence. The stability is attractive to the investors and allows the company to have a long-term business perspective. And following by personal perpetual succession, centralized management will be started. In a joint stock company, the company is managed by a board of directors elected by the shareholders. The shareholders have the ultimate control over the company through voting rights and at the annual general meeting AGM, but they do not have usually participate in day-to-day management. The centralized management allows for effective decision making and business strategy implementations. Ownership through shares. The ownership of joint stock company is divided into shares, which are the units of ownership. Each share represents a portion of the company's capital. Shareholders receive a portion of the profits, usually in the form of dividends based on the number of shares they own. The value of shares can fluctuate depending on the company's performance in the market. The last one will be ability to raise large capital. Since a joint stock company can issue a large number of shares to the public, it has the ability to raise significant amount of capital. This allows companies to undertake large-scale operations, expand their business and invest in new ventures. Public companies often raise capital through stock markets, issuing new shares to investors. And finally, we have completed the first chapter, joint stock company. And if you have any queries, you can comment it in the comment section. And please subscribe to our channel and wait for the next lesson to be uploaded. Thank you.